morning, everyone. It's great to be here. Thanks very much to Ryan for the introduction. Last time I had the pleasure of speaking at an AGBL conference, actually it was back in November 2019. Seems a very, very long time ago now, and I think this is the first in-person conference that has taken place certainly in the last couple of years. I was reflecting earlier today on what's happened in markets over that period, and I'm going to touch on some of these points as we go through my presentation. But if we think about some of the major indices, back in November 2019, UK 10-year government bond yields were at 0.7%. They're now about 4%, so a huge rise in interest rates, market interest rates. The FTSE 100 has risen by about 20% in total return terms over that period. The S&P about 50% over that period, and the NASDAQ about 90% over that period. So it's been a really great period, albeit some bumps along the way, it's fair to say, for equity investors, but clearly a much more challenging period in terms of fixed income markets. So I want to say a few things just about F&C in terms of our background and heritage and so on. I know there are many shareholders in the room. We are, as I'm sure many of you are aware, the oldest investment trust in the world. We were launched in 1868, so over 150 years ago. It's a very long pedigree. We've paid a dividend every single year since launch. We're the longest continually listed company in the UK, and we've had 52 consecutive years of rising dividends. We're not a high-yielding investment company. It's pretty low, actually, but 52 consecutive years of dividend rises thus far. Consistency in terms of portfolio management from both a corporate generally and an individual manager perspective. So I took over management of the trust in mid-2014, so almost 10 years ago. And we've been investing in equities for almost 100 years, investing in private markets since the 1940s, and we've got very substantial scale. So as of today, we're about a £5 billion market cap company. We're a member of the FTSE 100, around the 75th largest company in the UK. Our aims are to deliver long-term growth in capital and income. That is the overriding long-term objective. And having been invested in primarily in equities in recent decades, we've done a pretty good job, I think it's fair to say, in terms of delivery against that objective. The way that we seek to deliver on that objective is through investing in global growth assets. So what do I mean by that? I'll show you in a moment. But essentially, it's listed equity as well as private equity. And we blend a range of active strategies. So drawing on some of the points that Ryan made just a few moments ago, my primary job is not stock picking, but it's actually, I'm head of multi-asset in Columbia Threadneedle, beyond the fund manager of F&C. But my role on this trust is to source and select the best strategies for the trust in terms of equity exposure and private equity, and blend them in a manner which provides relatively consistent outcomes for shareholders. Now, clearly, again, as was discussed earlier, one can invest with a growth style, a value style, an income style, and so on. If one takes a narrow focus, either from a sectoral or a geographic or a stylistic perspective, you can get quite volatile performance. Maybe great performance in the long run, but it can be quite volatile along the way. What we look to do is blend different approaches to ensure that the journey for shareholders is as smooth as possible. So the outcome we seek to deliver is consistency in terms of performance delivery, and also value for money. So the charges for Columbia Threadneedle in terms of management of the trust is 0.3% up to £4 billion market cap and 25 basis points thereafter. And our ongoing charges are around about 50 basis points. So we're a relatively low-cost product, also bearing in mind that we invest into private markets. And our interests are aligned with you as shareholders, because we, as managers, get paid on the market capitalisation of the company. We have an incentive for the company to treat at a narrow discount, because basically we get paid more. So I'll make a few points about the recent evolution of the trust. So as I said, very long history, which we won't bore you with today, but Over the last decade or so, there's been some quite substantial changes to the trust, which I'll run through quickly just now, before going on to have a quick discussion with respect to markets, what's been happening, where we are, and what some of the key themes looking forward may well be. So there's a really significant change with respect to the strategic benchmarking of the trust that took place just before I got involved, and that was at the beginning of 2013. Pre that, there was a very substantial portion of the portfolio that was invested in UK equities, actually. Around 40% of the portfolio was benchmarked to the UK, 60% to non-UK. A decision was made that was implemented at the beginning of 2013 to move towards a wholly global mandate. And this is intended to give you a sense of the success of that decision. So UK equities have been a great investment. They've doubled in total return terms over that period. But global equities, obviously, for reasons I'll go on to discuss, led primarily by performance in the US and US technology, have far outperformed the UK market. So they've delivered around 3.5 times return over that period. So it's a really important strategic decision the board made to move towards a global mandate for the trust, which has been very successful in shareholder return terms. Secondly, just drawing further on those points previously, it's the real numbers, but somewhat stylized chart on the left there, whereby what I show you is there's different geographic exposure: US, Europe, emerging markets, Japan. There's global exposure, which obviously includes all of those geographic areas. There's private markets, private equity, and there's cash and liquidity. Within these respective areas, so Japan, this is a strategy. It's got about 20 stocks in it. It's run by the company I work for, Columbia Threadneedle. In the US, we've got 4 different strategies we run. JP Morgan Asset Management actually run a component for us. Barrow Hanley, who are a Dallas-based value manager, run a component for us. And in the private equity space, we source and select private equity funds as well as co-investments using Columbia Threadneedle and some other third-party providers. So we've got a blend of different strategies, not funds, but these are separate accounts, so investing directly into individual securities. And I'll show you the top 10 listed holdings as at the year end there as well. And there's many familiar names, the Magnificent Seven making an appearance there, as you can see. Debt. Now, one of the huge advantages that we've got as an investment company is the ability to borrow, and that can be a double-edged sword. Obviously, in falling markets, that can exacerbate the downside. In rising markets, as equities have tended to do in the long run, it can be additive to returns. Now, we've got around £580 million of fixed-rate debt. All of that fixed-rate debt has been taken out in the last 10 years at really attractive rates of interest. And the rates of interest are shown here. So we've got different tenors, so 0 to 10, 10 to 20, 20 to 30, and so on. And that's the interest rate on average we're paying by block of borrowings. And then you can see how much borrowings we've got in each area. So it's basically very well diversified from a time perspective and very, very low fixed rates. And in fact, in that 30 to 40 year area, we did a borrowing out to 2061. So that was a 40-year issue of debt by the trust at 1.87% fixed rate. Now, I don't think any of us will ever see the ability to borrow at such a low interest rate for a corporate again. So this creates a really low hurdle from which we can add value. If we put that money to work that we are borrowing at a blended rate of 2.4%, it's a really low hurdle. If we make returns on the assets, equities above that, it'll be additive to returns. So that's really, really important to recognise as well. Drawing the point on dividends and revenue, a very long track record in terms of growing dividends. That is the dark bar here. I just show a shorter term snapshot. We've got a covered dividend as well, which means that we've got the income that we earn exceeds the dividends that we pay out to shareholders. And then finally, before I go on to talk about markets, performance. There's different ways to think about performance, and I've got a bunch of different metrics here on the left-hand side. And this is somewhat selective on the left-hand side because this is when I took over the management of the trust, which was July 2014. The IE median is basically open-ended funds, so that's not investment trust, that's OICs, open-ended products. Then you've got a Vanguard ETF, that's a passive product. To the point on investing in passive, you can choose passive to invest. Many investors do for good reason, and that is track the index, which is the FTSE All World. Then you've got in the light blue line, on the fourth along is our NAV total return, which has exceeded the benchmark. You've got the AIC median, which is the closed-end comparator. So that's my global peers. We've exceeded the global closed-ended comparators. And then there's the share price total return. So the NAV, the share price discount to NAV reduction has enhanced returns for shareholders, and we're comfortably ahead of competitor returns there. So it's been a good outturn over the last decade. And to the point on consistency, last year was somewhat challenging, I think it's fair to say, in terms of our performance. We were underweight the Magnificent Seven. Private equity was a drag in terms of our relative returns. We delivered, and this is to the end of January, over the last year, second quartile NAV returns, third quartile shareholder returns, but all other periods are first or second. So this diversified approach, looking to blend different styles, the proof statement of consistency, I think, is evident in these results. So I'm going to make a few points just with respect to some key market issues, some of the things we're thinking about. None of us have a crystal ball, clearly, in terms of either the short or the longer term, but I think there are some interesting dynamics that are happening short term in terms of the global economy as well as markets. So some of the things that we are thinking about, and if we'd had this conversation 12 months ago, the real concern, or one of the big concerns, would have been an imminent US recession. Most economists were expecting that the US was going to be heading into recession. That was on the back of one of the sharpest tightenings in monetary policy that we've ever seen, with rates going from effectively 0 to 5.25%, 5.5%. In the US, a move from quantitative easing, where central banks are providing liquidity, to quantitative tightening, shrinking balance sheets. That's bad for financial assets, generally. And the expectation was that this was going to lead to quite a sharp slowdown in the US economy. That simply has not happened. The US economy, as I'll show you in a moment, has performed far better than we and most others would have expected. And it looks very much like the soft landing, which looked like a very long shot 12 months ago, is going to happen. What I mean by that is basically recession will be avoided, the economy will slow but not tip over into contraction, inflation will continue to decline as it has been, and actually the central banks will start cutting interest rates, and probably around the middle of the year. Second point is market breadth. Really important factor in equity markets, and debate is about market breadth. Now, this relates, and I'll be interested to hear what Ben's going to say on technology stocks later on, to the Magnificent Seven, those huge US mega cap stocks which are driving market returns. 75% of S&P returns year to date are driven by 5 names. I think 90% of technology returns year to date are driven by 3 names. 30% of market cap in the US is now, from that small cohort of stocks. So the market is very concentrated, and breadth has narrowed, and there are different views on what that means looking forward, but it certainly is a notable point. Third point is market pricing. There's some real disparity within the market from a pricing perspective. We can talk about interest rates, and I'll show you expectations there in a moment, but interest rate expectations are quite aggressive. People expect rates to be cut quite sharply. That's reversed a bit in the last few weeks or so, quite markedly. But rates are expected to come down very sharply this year in the US, UK, and Europe. And in equities, in the US, valuations are high, and they look very high in certain areas. And again, that's a point of debate. Are these valuations justifiable or not? And because of the valuation disparity between the US and the rest of the world, this is giving rise to debate about opportunities outside of the US. And Japan, interestingly, within 1% or so of its all-time high, some of you may remember, back in 1989, around 39,000 in the Nikkei. Markets don't always go up forever. The Nikkei collapsed and has just about hit that level. So there are good opportunities outside the US as well. And I think the case for diversification, which is really the punchline, is very strong. Many uncertainties. Valuations do look stretched in certain areas, and therefore I do think, while certainly technology and those big names which are prominent in our top 10 holdings deserve a place in your portfolio, one should not concentrate all your risk in terms of that exposure. I'm going to run through, just in the interest of time, just a few points in terms of slides, and just again reflecting on some of the differential performance that we've seen in equities from a geographic perspective. First slide shows you the US there, which is the dark blue line, and this is reset, so the 1st of January reflects 100 in terms of index returns. China's been a huge laggard, and obviously faces huge potential further risks from a trade perspective, depending upon political outcomes later this year. Looks very, very cheap by any historic metric, but faces huge domestic challenges in terms of the growth picture, as well as huge political and trade challenges. But that is a huge disparity you can see between the US, emerging markets, and developed markets, excluding the US, sitting somewhere in between. Now, returns in the last year or so have been driven in 23 really was a mirror image of what we saw in 2022. 2022 was all about multiple contractions, markets getting cheaper, despite the fact earnings were okay. Last year, and the grey bar here shows what's happened in terms of price earnings multiples. Price earnings multiples have gone up. People are paying more for equities. Earnings have been pretty good, actually. And if you look at that acronym at the left, the second from the end there is MANAMAT, the Magnificent Seven, phenomenal period, but they've delivered phenomenal earnings growth. So multiples have increased, but they've actually delivered really strong earnings growth, which has far outstripped the market and certainly non-US opportunities. But markets are much more expensive on forward multiples than they were 12 months ago. And valuations in the US, I made this point already, valuations in the US are relatively high. We're paying about 20 times or thereabouts for the next 12 months' earnings. That is quite high relative to history. That's the dark blue line here. And there's a big gap between what we see in the US and what we see in the rest of the world. Now, again, last time I was here, I had a debate or a discussion about, UK's cheap. UK's always cheap, or certainly has always been cheap in the last few years. Is it a value trap? I said it was a value trap back in 2019. I wouldn't be as strong on that today. But to some extent, you're paying a premium for growth. You are paying a premium for growth in the US market. The question, as always, is that premium appropriate or not? But it's pretty large compared to what we've seen historically, for sure. Now, just reflecting again on 2023 and what happened, the US, again, 12 months ago, low expectations and constant upgrades in terms of what the growth outturn was. The UK wasn't as bad as people expected, and the Eurozone was a disappointment, unfortunately, once again. And the picture more recently, when one looks at Purchasing Managers Index, which are intended to give some higher frequency sense on what's happening from a growth perspective, show that actually the growth picture is improving in terms of the US and the UK. The Eurozone, which is the bottom line there, is still pretty stagnant in terms of what's happening from an overall growth perspective. That's pretty important in terms of the earnings picture, as I'll show you as we go through. I'm just going to run through core inflation. Core inflation has fallen very quickly, and we are enjoying what has been termed an immaculate disinflation in terms of the global economy. People did not generally anticipate this previously, and it does look, if one looks at a consensus forecast, in the UK it's expected that inflation is going to drop to around 2% by year end, and in fact headline inflation may well drop below 2% come April, May time, given some of the base effects. So there's quite a sharp decline in inflation, and that is despite the fact labour markets remain tight. And that is good news in terms of interest rates. So what you've seen is where current short rates are in the US, the UK, and the Eurozone, and where the market expects them to be by year end. This is a bit out of date, only a couple of weeks or something. The blue bars have backed up a little bit. Markets are not quite as aggressive in terms of expecting those very sharp interest rate cuts, but nonetheless, interest rate cuts, the market firmly believes, are coming, with June the most likely date for the US Federal Reserve as the most important global central bank to start cutting rates. What does that mean for equities? Normally, interest rate cuts are pretty good. This chart here shows you the days around the last Fed hike and the current cycle. So if we assume the last Fed hike that we saw is the last of the cycle, Then we're about 150 days past that or thereabouts, and that's the red line. And it's tracking to type. If after rates peak and rates start coming down, that is normally quite good for equity market returns, and markets are responding accordingly. Sorry, one point I would just make on this chart is the run-up that we saw to the first rate hike was quite unusual, though. Markets performed very, very strongly into the rate hike, whereas normally they're kind of flat to maybe down. That is quite unusual. That is quite unusual, I have to say. Bonds, no longer return-free risk. I'm not pushing a bond fund here, but we made some fantastic borrowings. Well, I hope we made some fantastic borrowing decisions, back a few years ago. But we've seen rates move up very markedly, so that if you're buying government bonds at close to 0% yields, then it was a return-free risk. You were not getting a return, and the risk was of capital loss. That capital loss has occurred. Rates are now much more attractive, and certainly credit spreads are tight if you're looking at corporate bond markets. But bonds are once again an area I think worthy of investment. I am being told that my time is pretty much up, so I'll just make a couple of final points, if I may, just on technology. The Magnificent Seven, again, I'm sure we're going to hear more about this, is big debate. I think what is somewhat encouraging, although we can look at this one of two ways, is that the Magnificent Seven stocks here, dark blue line, phenomenal performance. Junk, loss-making tech had been following tracking performance, up until that bust which occurred in 2021. There's been limited recovery in terms of that low-quality tech. It's the high-quality stocks that are outperforming. The question remains, the price that you pay, the premium that you pay for those stocks, and you're paying a pretty substantial premium relative to history, albeit the point I made earlier on, they have delivered fantastic earnings growth, but the premium one is paying for the Magnificent Seven. And just without stretching the analogies to the previous bubbles too far, this just gives you a sense of where we stood at the end of the 1990s. Cyclically adjusted P is basically current price divided by a historic earnings number to smooth out some short-term fluctuations, and that is the dark line here. And you can see the NASDAQ Cape went up to 100 times, and the poster child at the time, Cisco, I think their short-term multiple went up to 200 times. Now the Cape is high, it's about 40 times, but it's way, way below what we saw previously. Expected earnings growth, very high, however. So there may be more to go for. We certainly retain exposure to those areas, and I think the fundamental picture is very strong. And I will leave it there, but thank you very much for your time.